Well, good morning, everybody. Welcome back, and thanks to this day 2 of DDC's Global.
Hello, do you hear me?
We're very pleased to today with the Italian panel, which will be delving into various different aspects of the Italian debt market. We have a fantastic panel lined up today of some gentlemen with very differing views, which should give a nice overall perspective. And the panel is led by the very capable hands of Mr. Norman Pepe. So welcome everybody, and Norman, take it away. Thank you.
Thank you, Martin. So welcome everybody to this this panel, which will focus on the Italian debt market. We will, as Martin said, we have a very interesting panel. The idea is to go through through few blocks of topics. We will first touch upon the COVID-19 measures in Italy. Then we will have an overview, an overlook on the market to see what's going on. And then we will focus on each separate asset class. In terms of how we would like to do this panel, we convened before this before the formal meeting to agree on the fact that we would like the panel, the conversation, to be as interactive as possible. So even between the panelists, there will be some interaction. You know, people can interject into others' speech so that things gets a little bit more active. And we would like, and we invite the audience to do the same, so sending questions so that we can somehow stick them into our conversation. In terms of the members of the panel, I will leave to each of them the possibility to introduce more completely themselves. But we have 5 people, except myself. So we have Matteo Gallanti from NCTM, a business lawyer, quite renowned business lawyer and a friend of mine. Then we have Paolo Pellegrini from Cerved. I think it's, Paolo, you are the general manager of Cerved. So, you know, part of the top management of one of the biggest servicer, which is also, by the way, a listed company, if I'm not wrong. Renato Limuti from Alantra. Renato is the head of credit portfolio advisory in Italy. And then we have Paolo Peruzzetto, although Paolo is still not showing up. He has some technical problems, I think, who's the head of sales of Credito Fondiario. Before leaving the floor to them, I just want to mention that this is a very interesting panel in my view, because if you have been following what is happening in Italy, you will know that you know, Alantra has been very, very active recently. Credito Fondiario even more, and maybe Paolo Peruzzetto can tell us more about what they're doing in Italy, since they are one of you know, one of the few players who do everything from servicing, investment, securitization services, etc. So, and obviously Matteo and Paolo, they're very well adversed in the market. So I will start with Matteo and then move on to Paolo, Renato, and hopefully Paolo Peruzzetto if he manages to get in.
Okay, so my name is Matteo Gallanti. I'm a lawyer. I'm a partner at NCTM, which is an Italian-based law firm with offices in Milan and Rome. I'm actually based at the London office, which is an office which we opened in the middle of the Lehman Brothers post-crunch in late 2008. And since then, I'm being based in London, even, of course, I used to spend, now it's a bit more complicated to travel in and out of the UK, in Italy. Basically, what NCTM is a global firm, so which offers almost all the areas in the legal fields, except probably family law. But I'm part of the banking and finance group, which is traditionally works for traditional banking, corporate and acquisition banking type of transactions. specifically, I've always been involved, even before joining NCTM, in structure finance, with particular focus on securitization type of transactions. First for a US firm based in London, and I was actually at Lehman Brothers before the collapse of the bank. But and then I think that the focus, especially in the last few years, which is something we will touch base in the next couple of during this hour, is a lot of work on distress assets, and having a background in securitization, a lot of work on the NPL and UTP transactions, because at the end, as many of you who have been maybe exposed to the Italian market, it's the most common type of structure which is used for Italian and non-Italian purchaser of portfolio or single name positions.
Thank you very much, Matteo. Paolo, would you like to introduce yourself and Cerved?
Yeah, thank you, Norman. So I am Paolo Pellegrini. I'm the general manager of Cerved Credit Management, which is part of Cerved Group. Cerved Group at the moment is a listed company at the Italian Stock Exchange, but we are under a takeover bid by Ion Group. So maybe in a few months it will not be like we are now. So just to make this. As a servicer, we are one of the main players in the Italian market. I think that we are the second one by dimension. So we are a pure industrial player. So we are not an investor. So we are a platform of services on behalf of banks and investors, but we don't invest directly. And I think that we are one of the wider platform in Italy in terms of breadth of services, because we cover quite all the potential services, all the different credits, from the performing to performing, not performing, leasing, consumer finance, banking, extrajudicial activity, legal activity. So which I think it is one of the most, let's say, widest platform in Italy in terms of breadth of services.
Thank you very much. Renato?
Yes, good morning to everybody. This is Renato Limuti. I am Managing Director at Alantra, and I lead the credit portfolio advisory team here in Milan. It's a 10 people strong effort for the Italian market, but we work at an international level with 150 resources dedicated purely on the credit portfolio advisory business. Alantra is a global investment bank operating in more than 20 countries. We are listed in Spain, and we have three pillars. The first one being the traditional activity of banking, so M&A, ECM, DCM, active in Italy since now more than 10 years. Alternative asset management with 15 billion under management across direct and indirect and sort of private banking activities in the jurisdiction where we are active. And then, as mentioned, there is the business side here for the country, which is a rather a specialist approach for a bank like us, which has 550 global resources, of which 150 in this specific niche. So it's an area of focus for us. We are active on everything which goes from a straight sale advisory for leading financial institutions to securitizations of non-performing and performing assets, to a platform advisory M&A business for companies in the
if you click on it, you can manipulate.
I finished. Norman, leave it back to you, and I guess it's time to Paolo. Anyway.
Hopefully Paolo is ready. Let's see. Paolo, you want to unmute yourself and see if you can hear us? Okay, we will go back to Paolo as soon as he manages this little issue. So let's start with the party. So as I said, the first question is going to be the first round. The first section of the panel is going to be around the COVID-19 measures implemented in Italy. So I will start with Matteo. I will ask him to give us an overview of these measures so that we can, you know, somehow define the environment in which then the other speakers may bring in their experience.
No, thank you, Norman. Of course, I mean, starting for COVID, it comes quite natural given the situation where we all, and when I mean all globally, we find ourselves. And of course, it's a bit the big elephant in the room. And then it's something that is affecting probably most of the aspects of the global economy. And it's particularly interesting in relation to what's happening also in the sort of debt and market. The Italian government, like many other government across Europe and outside Europe, have implemented some, let's call emergency measures which I would divide in two types. We've seen measures where, let's say, we call moratoria or sort of suspension of certain existing regulations in order to give, let's say, oxygen to, in particular, companies and in particular small or medium-sized companies, and which has sometimes been extended to individual to individual businesses, which means, for example, certain type of professionals or individual. Then we have also had a second type of measures, which are sort of like aimed at providing or facilitate the provision of money to businesses which have been suffering for a decrease in incomes or supplies or customer demand. Without going into too many details, which maybe given the time we have might become a bit time consuming, I would say that the main measures we have seen have been the suspension of the possibility of proceeding to the request of bankruptcy or insolvency of companies. These measures are coming to an end, except the entering into force of the new bankruptcy code, which we will see that this date will remain valid, which has been moved to 1st of September 2021. Then, for example, certain reporting to the tax authorities in relation to bad debt situation has been postponed. So this has also an impact on the VAT payments, which has been sort of like became advantages for businesses which apply VAT to certain type of services. Then there's been a suspension of the obligation to capital increases in case of the capital has been eaten by losses, and this measure will apply for the next financial exercises up to a maximum of 5 years. Then we had measures which are very important, and then this is probably the most crucial also from a social perspective. It's the suspension of the dismissals of employees. These measures is coming to an end on the 1st of July, so in less than a week, unless the companies will still go to the follow system provided by what you call in Italy Cassa Integrazione Ordinaria. And then this goes together with other measures to provide liquidity or facilitate liquidity to companies. So the main measures been the provision of state guarantee to certain type of financial transactions, particularly loans and factoring transactions. It doesn't apply to all companies, but it's been focusing on the companies that we have seen probably the most affected by the COVID emergency already from the first wave, which are the small and medium enterprises. Then there have been extension also to other type of companies, but provided that you satisfy certain criteria, I think that with some delays in payments, this measure has been quite effective. If you look at the data available on what is called also the website of the Fondo di Garanzia, you could see that the demand has been almost, the financing almost at 200 million. Then I would mention also what is called the SACE guarantee, which is which is a system providing to facilitate the banks in financing, because of course there is a reduction of risk of non-repayment by the borrowers. Then we have some suspension in terms of repayment, which is now still applicable to capital, the capital part of the debt. And these are, I would say, the main measures. Now, the point is, what happens once these measures will cease to apply? Some of them already stopped. Some of them will probably apply for, I would say, probably overall for the rest of 2021. And maybe that's the big question mark regarding
exactly. And that's exactly the question that I would like to pass on Paolo. I would like Paolo Pellegrini in particular to tell us more about his experience of what kind of impact COVID and all these COVID-19 measures, urgent measures had on their operation, and what kind of impact he thinks they will have looking at the future. In the meanwhile, I want to take a little break to welcome Paolo Peruzzetto, who made it at the end.
Hello.
Thank you very much, Paolo.
Sorry, I'm really sorry.
No problem, no problem. It happens all the time to everybody. So we already introduced everybody. I think that when I will ask you the question, then you can tell us more about yourself and
Sure.
Credito Fondiario. But now, I mean, we are in the middle of a conversation with Paolo Pellegrini, so I will leave the floor to him to.
Thank you, Norman.
No problem. Thank you, Paolo. Your floor.
Oh, thank you, Norman. Let's say that the COVID has been really a challenging period. Let's say I would call it a journey, because let's say each different phase have different challenges, and we are not already out of the tunnel. Now, maybe in terms of implication, we are in the middle of the journey. Let's say maybe in the last year, the first urgency was an operative urgency, because the first challenge was how to maintain full, let's say, operation in a context in which you cannot go in the offices. No? I think that we have been quite effective in putting all the people in working at home in, I would say, 1 week. But I know that I remember, evening calls after every call of Conte, just to understand what will happen today, tomorrow, because the rules change every day, every week, and so it was quite necessary to be very prompt in also giving serenity to the people, because they wanted to know that they could work in a full security. The second challenge arrived soon after, because the impact of most of the measures had a strong impact on the collection. I would say that the strongest impact has been in the April and May of last year, when we've seen that the collection dropped by 50% versus what was the previous expectation. Then we had a partial recovery, and we hoped that 2021 could be, say, a normalized year. But honestly speaking, I would say that even in the first part of the year, we had, let's say, some strong impact, and I will go in detail what was the implication. And I think that the situation will be normalized maybe by the end of the year. No? The main issue is linked not on the, let's say, liquidity of the debtors of the companies, but on the judicial procedure, because when the court have been blocked, everything has been frozen for several months, and even after, when the operativity of the courts start again, we had, let's say, a sort of backlog of activity, and even in this first month of the year, we've seen that the number of auctions, the number of assets sold to auctions is strongly, let's say, impacted versus the previous year. No? So in January, February, we have seen that the number of auctions were minus 30–40% versus 2020. So we cannot say that. And honestly, all this has an impact on not on the month collection, but on the plus 3 month collection, because once you have an auction, the distribution of cash is not immediate, but you have the, so you get a collection now of the auction that have been held in the beginning of the year. No, so it will be a smooth, let's say, normalization that we hope we will be in a normal situation again by the end of the year, not before. This is our. The third challenge is about how to reinvent our work, because the needs of the market have changed incredibly. For a long period, all the banks, if you see the numbers, say that we have not NPL anymore. No? The stock of NPL is reducing because all the effect of the moratoria suspension have been a sort of freezing of the stock. And so the needs of the bank was not how to manage a huge stock of NPL, but how to manage the extraordinary measures. So we for example, we put at work 100 people to support, let's say, the banks in the application of the state guarantees. No, so we have so we have a very broad, let's say, services, and so we also give these services to the banks, and the team that was working on the application state guarantees was we used to manage like 100 cases per month. No, from 100 it arrives to more than 1,000. No, and so we need to scale up the operation immediately. No, so you have to have great flexibility to change your activity month after month. And I think that the thing is, it has not changed, because this is not stopped, because when the market will start again, and is starting, so the asset that will come to the market will be significantly different from the ones that we were used to work 1 year ago, because most of the NPLs have been already out of the banks, and you will have to manage fresh UTP. There is a complete different activity with a complete different, let's say, operating model. So if in this complex period you have not, let's say, put enough focus to reinvent your activity, you will be not ready when the challenge of the market will come to you in a few months. So I think it's a complex but interesting and challenging period.
Thank you, Paolo. Thank you very much. So I will leave the floor to Paolo Peruzzetto. Thank you, first of all, Paolo, to stick with our white shirt policy, which Renato, for some reason, didn't want to comply with. So please introduce yourself, introduce your Credito Fondiario, although I assume that everybody knows about them, about you and your company. And the question will be, if you can give us your view on, UTPs from in the COVID environment, which is basically where Paolo Pellegrini finished his intervention. Thank you very much.
Thank you, Norman, and I'm pleased to join this panel with this great panelists. And just a brief introduction of myself. I'm Paolo Peruzzetto, at sales at Credito Fondiario. I'm responsible for the business development of and origination structure of Credito Fondiario in the several tasks that we manage. In particular, Credito Fondiario is a debt servicer and debt purchaser in the Italian NPL market. We also provide services to third parties investors. Just before reviewing what we manage currently more than 50 billion of assets under management, of which 20 billion in special servicing. But going directly to the question, in particular with respect to UTPs during COVID, what we see is that for the type of UTPs managed by us, I think that would be the same for other servicer. During 2020, the activities carried out regularly in a good manner, in the sense that some of these debtors were already involved in agreement or restructuring agreement with us, and so we try to manage properly the needs of that debtors. But I think that the new challenge for servicer and also for banks concern the new wave of TPs that we are facing, in particular for the debtors that after moratoria and government measures will face difficulties in starting repaying their debt, and we think that there will be also a change on the type of UTPs we will face from a servicing perspective, in the sense that we expect more UTPs from granular SMEs, smaller SMEs, or in general retail. And the approach to this kind of debtor is completely different, as Paolo Pellegrini said before. What is needed by the market is that a new approach to the servicing, and in particular a 360 NPA management servicer that can dialogue with different methods with the debtors, and for sure for retailers, technology can help and support also the servicing recovery for that debtors. And I think also banks are for sure more prepared than the past for this new wave, but at the same time they are concerned about the potential impact on their balance sheet, and that's why one of the ways they are thinking is try to continue the leveraging process they made during the past years in order to prepare for this new wave, because there will be the impact of the calendar provisioning for UTPs, but also there will be a new wave for NPL, for that UTPs that after the moratoria or after the government measures, they will be now able to repay the debt. So, as Paolo Pellegrini correctly said before, there will be new challenge for servicer, new challenge for banks, but will be an interesting period for both.
Thank you, Paolo. In fact, hopefully we will have time to get into the details of this when we will talk about the different asset classes. So let's move to Renato. I would like to understand, that's the final, Renato will cover the final bit. So we know that we have seen what has happened, what kind of measures are in place. We've seen what impact this measure had on the recovery process and are going to have likely on the stock of NPLs. So Renato, do you want to tell us your view about what we will be doing with all these new receivables, loans, whether performing or non-performing, generated as a result of the COVID-19 measures?
Yeah, thanks, Norman. I guess we all here in the panel, but generally speaking, have on our bed table a copy of the Piano Nazionale di Resilienza and development, ripresa, whatever. And we all hope that things are gonna go better, and there's not gonna be major impact from a credit perspective on outstanding loans. But the reality is that we all expect to one way or another that a considerable part of the exposures which have been financed or refinanced, for to utilize a better word, during these couple of years will experience triggers of default in the next years. This is not probably a case for 2021. So we are talking about more 2022, beginning of 2023. We will have a large chunk of new flows coming from exposures which have been tainted by guarantees. So what happened in the past months? We have seen moratoria. We have seen banks taking a proactive stance in financing their clients by providing new finance that in part refinance what they have in place, and in part, provides aid and support for the lack of turnover in the past month, benefiting of guarantees provided by the state. So we all know about SACE, MCC, and all the other instruments that have been discussed in detail by Matteo at the beginning of the conversation. Today, if we want to use a pictorial kind of framework, a borrower within banks may look as a mountain with snow on the peak. The mountain is the debtor, and just part of the mountain is covered by the snow. It is very difficult. It will be very difficult when defaults will come live to divest or dispose the non-performing exposures on borrowers which are partially covered, partially not covered by guarantees. Well, obviously now, and we will cover this at a later stage, we are focusing on our personal pipeline for the next 6 to 12 months. But obviously, as a business player, we are looking also ahead, and we envisage, or at least we probably hope, for the system taking a bit for a second, changing our hat with a more institutional. We wish that banks and all involved stakeholders from the state downwards could probably change the way at addressing the problem. And how? Probably by anticipating the solution of the problem. So if we wait for those credits to be underperforming or stressed, we will have to solve this conundrum where, again, there's the mountaintop where it's difficult to understand who's going to service that credit, because banks probably would not be particularly incentivized to service something which has been guaranteed by the state directly or indirectly. So what if we all identify high risk or higher risk sub-segment of the credit portfolios within banks' balance sheets at the moment, and what if we put in place, we meaning the system, structured disposal programs whereby the credits get somehow transferred away from the balance sheet of the banks with a pre-agreed servicing approach in the case of performing. So basically it's the bank continue servicing the assets, or non-performing special services, being them private or public, because obviously the state in this specific case has a vested interest, and we do it now. So I think this is a framework that could take place, and I understand that there is interest around, and maybe discussions already pending, because that can be the solution. From a structured finance perspective, and Norman, you are the master here, this can take the format of a cash securitization, of a synthetic securitization. There are several technical aspects that can be discussed, but the primary problem here is who's going to service those credits, under which scheme and which incentive most of all.
Thank you very much. This is something we can discuss also with Matteo. See, next time we will talk all together. But it's an interesting proposal, and clearly, at least my impression is that this is something that has been discussed. It's not just something that you are thinking about. So it's very interesting. It would be nice to to know more about the development or future development of this kind of conversation, because I agree with you. It's critical to act preventively before the problem becomes, you know, very problematic, very unsolvable, as you said. We
know, Norman, more or less, we can expect what can be the default rate of those loans. And we can do it. We have models. Everybody, not in the business, can develop models to understand what is the probability of default of those exposures, being them the large ones, observable on a line-by-line basis. I'm thinking about the such exposures, or the smaller, more granular ones. Once you identify the systemic default rate, you can ex ante put together a transaction, which is much easier than working, again, sorry to repeat the concept again, once they are defaulted, because in that case, the king is naked, and it's difficult to make him wearing cloth again.
Yeah, I'm wondering whether this could somehow match the GAC structure, where already again the government has a different exposure. Obviously, we're not talking about bad loans in this case, so but maybe that could be something that, you know, can be used.
The opposite of the GACs, Norman. It could really be the opposite of the GACs, with the state taking the junior tranche. In this case, they would cap the total amount of guarantees they provided. So let's say that the state today is in place, I just guesstimating, 500 billions of total exposure, potential exposure. We know that it is impossible that all defaults will happen. So it's impossible that there is a risk that the ceiling of 500 billion gets hit, but it's still potential and it's still a liability. If you estimate that this 500 billion can become a cash guarantee, so a junior note within such a structure of 100, 200 billion, you're already diminishing that amount, and you put it in a junior of a transaction, and the state has the means to service in a very direct way that portfolio, and maybe their own servicer can participate and contract other services from the private sector to coordinate the approach of UTPs and NPLs to come.
So it would be something like, you know, the cover, the synthetic coverage of the first loss through the such a tranche covered structure, but with the servicing element, the servicing component, which will give more substance to the recovery process. That's what
exactly. Then you can really be creative in the way you put together you know, those features, and you know, we are very creative when we put together slides and structures. But yes, that's the main feeling, Norman.
Thank you very much. So let's move on to the second part of the panel, the discussion. This is going to be more commercial, possibly. And now I would like to get from each of you an outlook on the market. It would be also interesting for some of you to discuss, if you wish, some recent transaction that you have completed or you're about to complete, just to give a flavor also of what is happening right now in the market. So I will start with Paolo Pellegrini, and then move on to Paolo Peruzzetto, etc. Paolo, the floor is yours.
Yeah, thank you. No, I must start from what Renato has said, because I think that in Italy we have an incredible, let's say, we are a benchmark for Europe in terms of creativity, you know, in structuring the solution for manage the NPE business, you know, because you've seen that in Greece they copied our gas scheme, so we are really ahead, you know. So we had this tremendous opportunity, you know, try to find a solution for a very huge problem, and now we are seen as, let's say, the leader, no, of this market all around Europe. No, they're looking to Italy to understand what's going on here, no, just to copy and paste. And I would say that in the last 5 years, 10 years, so the solution pop up like each time. So 5 years ago, the mainstream was competitive processes. Now, when the bank had to dislocate, an NP book to an investor, the main process was the competitive, let's say, auction through with different investors. Now, this was maybe 90% of the transaction. Then from 2017 to 2019, the mainstream was GACS. So we have still had some competitive processes, but I would say that 80% of the dislocation went to GACS, which was an incredible innovation in the market, because they had banks in reducing the gap between, and I'm not saying that GACS have ended, so GACS are still there. There are still some processes, but now, since the challenges of the market are changing, we have seen that there are popping up other solutions, And we have seen that we have real estate securitization, we have contribution fund, we have marketplace to manage the secondary market. So each time that the market needs a different solution, we find a different, let's say, structure. And maybe it's too difficult to cover all this potential, let's say, innovation. I would focus on maybe one in which we are involved, and I think it's quite something that is quite popular in this moment. It's the contribution fund, because on UTP you could not say leverage on the GACS scheme because it's not applicable by law on the UTP, and so you have to find a different solution. So what the market have found, but it's something that is not fresh, because some players have started contribution funds, I think 5 years ago, But the difference is that were very niche solution for single names of few players that were focused on very specific cases. The challenge is to scale down the solution to granular position and to industrialize this process, because you cannot afford to make, let's say, 6-month due diligence on a single case in order to understand if the contribution fund is a solution. So you have to industrialize your process, to go through data, to go through scores, to price the position, and to manage them in a different way once the position are put in this fund. The challenge is that you need more than one player, because if you want to deconsolidate from the books of the bank, you need at least 4 or 5 banks that are joining this contribution fund. Each of them should not have the same exposure that is more than 20-25% of the underlying value of the portfolio. And but I think that in this moment, you see on the paper every week, all the main services, the main investors are launching their contribution fund. And I don't want to make the names of the competitor solution, but we are working with Polis and with the support also of Price to start our solution, which is the Polis, the Taurus fund. But there are many solutions like this. And so I'm not saying that it will be the one-stop solution. I think that when you have a book of different problems, you need a book of different solutions. So maybe you will use the contribution fund for the UTP, the GACS for the FPL, the marketplace for single names. So all these instruments will help and I think that we will far more ready than 5 years ago. So I think that we will not have this increase of NP in the books of the banks, because the banks will be able to dislocate this asset very quickly to all these instruments that were not ready 5 years ago.
Thank you, Paolo. I would like to move to Paolo Peruzzetto. You can maybe tell us more about Credito Fondiario experience with another instrument, which is the GACS, or the rated, more generally rated transactions of NPLs, and the use of RIOCOs, internal RIOCOs, which are in part of the 130 structure. So I don't know if you can tell us more about what's going on with you.
Yes. Sure, Norman, thank you. I'm just adding a couple of words to what Paolo Pellegrini said before. I agree with you that now banks are more prepared than the past to choose what is the correct instrument for them for continue to push the leveraging process they've started in the past years, depending on the type of asset class. With the renewal of the GACS in Italy, for sure, banks will continue to use this instrument, because the guarantee on the senior notes issued by the SPV facilitated the reduction of the NPLs of the banks and reduced the BDAX spread and limit the losses for the bank. So what we see is that as last year, this year we continue, the GACS will continue to be used by the banks. We closed yesterday a transaction with Banco BPM, which is a GACS transaction, on which Credito Fondiario is involved for different roles. In addition to that, this is the first GACS transaction which Reoco structure is implemented, is native, implemented in the transaction documents and will be activated upon certain conditions, but is already structured in full, and Credito Fondiario acts also as a Reoco servicer and Reoco corporate servicer. We closed 6 months ago another GACS, which was the POP NPL 2020, originally structured by Luigi Luzzati, and we know that other banks are thinking and already started implementing GACS transaction to be closed by year end, and so this instrument will continue to be used actively. I think that Reoco, of course, as Reoco implemented by us in this kind of transaction, which are so-called Società Veicolo d'Appoggio according to Article 7.1 of Law 130, will be implemented in other transactions, also because they will give support to the servicing activity and allow to strengthen the activity for this kind of portfolios. Of course, it depends on the type of servicer. You need a servicer that is particularly structured internally in terms of teams, infrastructure, technology to manage this kind of real estate. We think to be one of the players more prepared on this, and also numbers confirms this kind of structure we have already structured internally. So what we see is that again, for this year, GACS transaction will be another way we use it to the banks for the leveraging processes, in addition to through sale competitive processes that they already implemented, usually in which we as Credito Fondiario also are invited as investors. And so so I think it will be another interesting year for this kind of transaction.
Thank you very much, Paolo. So the idea, I mean, you have you guys have implemented in this new transaction the Reoco platform that similar to the one that you had already in another transaction with
exactly.
BPM. So this means that that experience was successful insofar?
Yeah.
That's very important to know. Good, thank you. I will move back. I will move to Matteo Gallanti, who can tell us more about the single name market, which is a slightly different market with different players than portfolios, obviously. Also, the workout is different, the analysis is different. So maybe you can give us shed more light on that.
On that. So basically, what we have seen in parallel is to what has been discussed before. We have seen in the last maybe 18-24 months an increase of secondary market. A secondary market in different shapes. I think that we have purchased or bought portfolios in the first phase, 2013, 14, 15 onwards, which maybe they bought granular portfolios, and then they are sort of dismissing portions of those portfolios which are maybe not in the core business. The other thing is exactly an interest, especially by foreign investors, on single name positions, which is probably a different approach to the type of transaction because there is a thorough due diligence and a thorough workout, which of course we're talking about larger positions where there can be corporate or often distressed real estate. I think that that's something that we will keep seeing, because especially given sometimes especially for foreign investors, sometimes it's difficult to participate to competitive bids, where the resources to invest in the due diligence in the offer phase are and the chances of winning are not aligned. A single name transaction gives the opportunity for a potential buyer to discuss one-to-one with the seller to have a specific strategy on working out that position. So I think that this is something that we will keep seeing in the next 2-3 years.
And this is, how can I say, do you see a steady flow of transactions of this type?
Yes,
you see a very active market.
I think that there's been a bit of a pause, especially for the corporate distressed debt, because with emergency measures, of course, I think that there's been a bit of a slowdown, but we will see probably a peak from next year onwards.
But do you see only on NPLs and mainly backed by a real estate asset? Or you see also action on UTP single names?
No,
with,
you know,
a different...
all the areas, I would say.
All the areas. And do you see anything where also the use of the real estate securitization is part of the equation, or is still early to?
That's something that real estate securitization is something quite new in terms of structure, and I think that now. I think that the instrument which has been created by the amendment to the law 130, it doesn't specifically apply only to distressed real estate assets. And actually, I think probably that is a specific instrument. We've seen transactions where it's more related to pure real estate transactions, so where you have to relaunch an asset, but doesn't mean necessarily that we are talking about a default and the asset being an underlying a defaulted position. It's more of an instrument which is alternative to a fondo immobiliare, so a real estate fund.
I see. No, because personally I had conversation with clients about the possibility of using the real estate securitization in the context of a restructuring. So to isolate the real estate asset, which is the main asset of the debtor, and try in that way to inject new financing in the company. Yeah. Speaking about real estate securitization or 7.2 securitization, maybe Renato can tell us more about what is happening in the market, what is his views with the competitive processes. But he was recently involved he was in the front line in this interesting securitization regarding assets, hard assets. In that specific case, I think we were talking about cars, structured by let's say Brum Brum, which is this Italian company, which got I think 65 million of financing by securitizing these cars. Can you tell us more about the transaction itself, whatever you can tell, obviously, and
yes,
your views on the competitive processes? Thank you.
Yeah, let's start with the last point, because it's a good connection with what Matteo just said. The 7.2, the change of 7.2 article of Italian securitization law is very useful. And when it came through, I personally saw an opportunity to match the instrument, not only to the, let's say, NPL world of Rioco-like transactions, but to other asset classes, which can be considered, which are registered movable assets. So real estate, it's easy to imagine. I think, and that's what I hear as well from esteemed lawyers like you guys, that to some extent also the development component can be covered by those instruments. But the real interest I have on those is that we can use the instrument to create segregated, bankruptcy remote financing tools for growing companies. So something which is completely the opposite end of NPLs. In our case, which was announced yesterday, we advised Brum Brum, which is a leading e-commerce marketplace in the automotive sector, They do two things. They do used cars, so you can go and buy your car online, which has been refurbished and guaranteed for quite a long time. Or they wanted to launch a new product, which is the car as a service or operating leasing service, if you want. To do so, they needed to finance, quite a lot of capital to buy the cars and put them at service through long-term contracts. The solution we had, and that was already started at the end of 2019 and then launched last year, was to use the 7.2 platform, and we did it in a forward-looking way. So it's basically a platform which was issued this year for a ramp-up period of X months, let's say less than 2 years. The assets will be obviously purchased on the basis of eligibility criteria, which have been discussed in advance with the investors. And after a while, the amortization period starts when the capital amortization period starts when the first contracts start to expire. The total maturity is 6 years. And in our specific case, there are only 2 tranches: the junior, which is invested by Brum Brum, and the senior invested by Oaktree and P&G, which is a smaller Italian asset management firm. So why this is interesting? Because it can really be applied, the partly paid feature specifically can really be applied to a number of initiatives in the non-performing and performing space. Let's go now. I don't know, Norman, if I answered your question. Happy to.
Absolutely.
On the competitive bids side, well, that's our bread and butter. That's always been our bread and butter. It's true what Paolo said about the GACs. Since GACs launched, the lion's share of Italian NPL deleveraging has been done through GACs. Nevertheless, we have seen benchmark transactions last year and this year as well on the primary and secondary market. 2019 was around 40 billion euro deleveraging for the Italian market, and 2020 at the end was a similar number. We do expect a similar number again this year to happen. If on one hand the traditional secured or primarily secured NPL portfolio granular gets divested through a GACS, everything which is unsecured, nevertheless, on the primary side, goes to a to a competitive the primary and secondary side. For structural features, obviously, of the GACS, it is not convenient to put those claims predominantly into a GACS structure, unless in the residual part they will be valued poorly by the rating agencies. Then we have also other asset classes that are not GACSable, sorry for the bad term. The UTP corporates cannot be used this way, and honestly, we are looking more and more into new asset classes which are not necessarily loans. Take the real estate. Real estate weighs quite a lot within the balance sheets of the banks. If it is not used by the banks, it's a cost. It has an impact on the cost income of the bank, because the bank will continue to service a granular portfolio of useless real estate, and somehow it can be divested in a different way. So that is not going to be a GACS. And in this case, competitive processes leveraging on 7.2 securitization can be envisaged. To be frank, we are quite active in this front. Then we go to the residual part of the business. You know that there are some banks, UniCredit, which is a client we know very, very well, and Intesa, that regularly, anyways, come to market with non-GACS transactions. Last year, UniCredit divested 2.2 billion without GACS of NPLs. There has been a transaction announced these days with Crook and Mediobanca purchasing the unsecured credits, and obviously we all know about the large portfolios being sold by Intesa today. But apart from that, on the primary side, we have seen some secure portfolios, for instance, the winter portfolio from BPER last year, and some other ones of these same sides might materialize in the next few months. Why? Because if I'm a smaller size bank, either I participate to a multi-originator platform, which can be long and complicated to structure, or maybe if I have a good portfolio, I probably prefer to do a one-off deleveraging solution with a few investors in a competitive bid process managed by the Alantra-like of the day, possibly. Then we go to the secondary markets. I think I think it was Paolo Pellegrini who mentioned that in the past 15 minutes, before GACS, transactions were purchasing through competitive bids. Now, investors have been working on recoveries on those portfolios, and maybe the first layer, the first part of the process has been completed. So there is rationale for large portfolios of assets to be sold in the secondary market. I agree with what Matteo Gallanti was saying, that there is quite a lot of activity in the secondary market for smaller portfolios or single assets. Unfortunately, this is not, it cannot be our core business. But when it comes to large transactions, I can tell you that last year, 2020, well, Norman, you know very well because we did it together. We worked with Deutsche Bank to sell 1 billion assets of mixed portfolio in a structured, let's say, process to Eidos partners. This year, we completed the sale of Project Grey, which is a collection, a quite sizable collection of tails of assets acquired by York in the past years. It was 500 million euros, primarily unsecured assets, and it was done last week, concluded last week, and some other are in the pipeline, at least as far as concerned. So we are always talking about few transactions, 500 million plus. They will happen this year and next year anyways.
Thank you, Renato. So we already used up the entire hour that was given to you. I understand from Martin that we can still go on for, I don't know, something like 10 minutes, 7 minutes, something like that. I really would like each of you to discuss in 2 minutes each. You know, give us, if you could give us your view on the certain specific asset classes. We need to be quite fast because obviously the time is running out. So I will start with Paolo Pellegrini. Your view on SME corporate. What is going on? What will go on, and you know, what is the Cerved's view on this asset class?
We think that this will be the main asset class in the next couple of months. So this will be our core focus. You need, let's say, complete different, let's say, operations, so different skills of the loan managers. I will not call them loan managers, maybe advisor, and a different approach because you need an industrialized approach with a sort of triaging of the position done by data and so on. And not, let's say, in a case-by-case management, because otherwise it would be not possible to do it. So
Thank you.
Try to be short as possible, as much as short as possible.
Thank you, much appreciated. Matteo, we already discussed a little bit real estate securitization.
Yes, I think that, exactly.
Yeah.
That's a new instrument. I think it's very valuable what you said. I think that the tool is still ongoing. So we need to understand exactly what would be the use of it. Is more appropriate for performing assets or for non-performing or for corporate restructuring where you have an asset that you want to segregate. So this is a bit of a challenge. I think that we will see it's a because we've been seeing 3-4 transactions so far, maybe specifically dedicated to a specific asset to be relaunched, like hotels, especially in hospitality. So that's probably something that we'll see in the next 1-2 years. And then we'll see which is the space it will find.
Excellent. Paolo Peruzzetto, your view on large corporate. You guys are already in that sector. I think you're one of my main investors, I believe, in Italy. So I think your insight will be very valuable.
Yeah, thank you, Norman. I confirm we continue to be interested in investing in large corporate. We made a deal last year with buying 300 million GBV of GPs with regarding more or less 50 corporates. I think that for this asset class, what is important is the capability of the servicer to manage that position, in particular from a real estate perspective. So in this sense, we are structured on this. We think there will be other additional opportunities for this year.
Great. Renato, literally 60 seconds on unsecured residential granular portfolios and possible strategies.
I think, yes, there is. We haven't seen yet in Italy proper RPL transactions, so reperforming loan transactions. I think this is something we all should focus on, because there will be more, and because there is a market there from the investor side able to price, I use the word aggressively, those assets if the mismatch between knowledge from buyers and sellers gets filled. So banks have to work hard on providing those informations. In that case, I think we will see, as in other markets, more transactions on subsets of portfolio that have a life beyond sale, not only in a judicial kind of business plan, but on the borrower reperforming business plan basis. Absolutely.
So, Martin, I think we have really touched upon all possible topics on the matter. It was a really interesting journey, and I really would like to thank each panelist for their contribution, their talent, their skills, and the knowledge that they've shared with us. Personally, I'm very excited and pleased of this panel. And obviously, I would like to thank DDC for making the platform available to us to share our ideas and thoughts with the audience.
Thank you.
Indeed, Norman. Thank you very much.
Thank you.
Gentlemen, thanks for joining, and great job moderating. Bye-bye.
Thank you. Bye.
Thank you. Bye-bye.